Today we're talking about small business acquisition, and more specifically as an asset class, not just passive, like a limited partnership, one where you actually have a little bit more control, hopefully some higher returns on time and money. And we've seen a lot of success with people inspired by folks like Andrew Wilkinson or Sieva Kaczynski at Tiny. Many other people having hold companies or holdcos, as people are calling them, that are popping up. And just out of my own selfish interest, wanted to learn a little bit more about this, take you along for the ride. And today we're chatting with a friend, Andrew Gazdecki, who's the founder and CEO of a platform called Acquire that helps people buy and sell SMBs or startups, side projects, things that they either want to buy or sell. This is really a tremendous platform that's kind of helping people do that. And just as a little bit of backstory, Andrew, you keep me honest here, but started a company before called Bizness Apps while we're in college, Chico, or other people call it Stanford North Campus, and later sold that company, Bizness Apps, to a PE firm kind of post-graduation for an unconfirmed amount. Don't have to say, somewhere in tens of millions, maybe, no one really knows. But after having gone through that acquisition process, you kind of saw how painful and inefficient that was. So you started Acquire, formerly known as MicroAcquire, for any fans of Russ Hanneman out there. It's been backed by Bessemer Venture Partners, entrepreneurs like Dharmesh Shah, who's the HubSpot co-founder and CTO, Naval, and some others. Anything else you want to add to the list there, Andrew, of your accomplishments or why people should know you or trust you in the conversation?
No, Sean, that was a great intro. I would just say I like the Stanford analogy, but we typically use Harvard of the West for Chico State.
I just felt like that was overused, and with people like you, West Coast. Stanford gets a lot of clout around here these days, but people forget about the North Campus, so I had to give that one a plug.
I've never heard that one. It was good.
Feel free to use it again. But reasons I wanted to talk to Andrew today, especially about this, is we get a lot of folks and invest a lot in the private equity space, kind of lower middle market stuff, but no one's really given their secret sauce. People don't want to talk about that or what really, leads to their alpha or outperformance. Andrew's got, thousands of data points through the platform. You can see what's working, what's not working, different buyers, different sellers. You've got a lot of market transaction data. And these are typically companies selling, at least from what I've seen, in kind of 100,000 range to a few $1 million. So these could be small teams of people all the way through solo entrepreneurs or individual projects. Many of them very profitable. A lot of them kind of focused on software marketplaces. But I think more specifically, you've said to me before, look, if I wasn't doing Acquire or doing this business, this is what I would be doing. So I think that's a helpful context in terms of jumping into this today. But can you just give us a little bit of backstory on Acquire specifically? And I know and actually recall it was, I don't know when it started, but I remember we were kind of sitting, I think it was at your dining room table, and you're like, yeah, I don't know if this thing is going to work, but I want to start it. I don't know if that was just you being modest and you're like, actually, I know this thing's going to crush it, but I'm going to do this. But can you give us a little bit of just a 30-second background on Acquire?
Yeah, definitely. You touched on a lot of the points that I definitely always like to bring up. But yeah, I was fortunate enough to build and sell a SaaS company that I bootstrapped in college. And after going through that process, it kind of opened my eyes to just how confusing and how difficult acquisitions can be for entrepreneurs. And when you kind of think about it, there's like 100 books on fundraising, there's like 100 books on marketing, but there's really nothing for the exit, maybe like 1 or 2 books. And so I just saw this huge knowledge gap for entrepreneurs. And again, it's the most important part of the founder's journey, obviously, but you don't really learn too much about it. So that was kind of the initial thought process around, why I thought Acquire needed to exist. And yes, it was previously called MicroAcquire, and we dropped the micro over now, acquire.com. And yeah, so what we do as a company is we're a marketplace for specifically SaaS startups, agencies, e-commerce companies. Our main focus is typically SaaS, where the valuation is going to be between $500K to $3 million. And then we've done transactions more than that and below that. But one of the key things that we try to do as a company is we try to streamline acquisitions, We build software for buyers to quickly draft up a letter of intent, asset purchase agreement. We make escrow seamless as you're looking to buy a company. And then also just discovering different startups to acquire as a buyer. That's just been a huge problem for entrepreneurs and buyers to connect. And so that's one key thing that we solve. So as another example, if you're looking to buy, I think you touched on this, but a small SaaS company that's just doing, I don't know, let's call it 5 to 10,000 monthly recurring revenue. We have a ton of those different types of businesses. And those are great for people that are looking to buy a company and maybe grow it a little bit. So maybe you're experiencing startups or SaaS and you want to just get your hands dirty in acquisitions. So we have a number of those companies. Then once you get into the 500,000 to 3 million in enterprise value, that's where you might have a few contractors, you have strong product market fit. You can buy a company with some pretty decent cash flow. So we're talking, $100,000 to $500,000 or upwards of that. And then even beyond that as well, if you're looking bigger. So this is where we start getting into typical private equity, which is, typically above 5 million in enterprise value. And that's where we're going to see, over $1 million in cash flow. And that's where you can think about things like hiring a CEO, putting them into the business, and you're stepping back. That's more of a typical private equity model. So kind of elongated explanation of the business, but I hope that's helpful.
Yeah, super helpful. And I know there's a couple of different ways that we could take this conversation, both from buy side, sell side today. I think really the focus at this point is just looking at things from an acquisition standpoint, just because of the interest out there from investors who might be LPs in some of the private equity funds that you kind of referenced there, but maybe they want to get a little bit more involved. Maybe they're, working at a large tech company these days, and are thinking about doing something on their own. And for people, maybe rather than starting things from scratch, this is like a reasonable point. So I think that's kind of the frame of reference that I wanted to approach things from today. But you mentioned also that, kind of 500K to 3 million is a little bit of the sweet spot. Was that intentional when you started things? Is that just kind of the way that the cards fell? Why that range?
That's a great question. I would say that's kind of the range where we've really opened up a new market. And what I mean by that is a lot of people don't know this. They think of acquisitions, especially if you're an entrepreneur, you're thinking that, I don't know, Google, Apple, Facebook is the only people that acquire companies. And this has also been to my surprise, but there's been a big rise in what I'd call the emergence of the individual buyer. So exactly like the person you're describing. So someone that just wants to be the CEO of a tech company, has some sort of experience in sales, marketing, product design, whatever it may be, some important component of a typical tech company or startup. And so that's kind of the range that a lot of individual buyers are going to be looking at. You can also apply an SBA loan. So there's a large pool of individuals that are looking at these businesses in the lens of, I hate my job. I'd like to, potentially buy a business, and this is what I'm going to do. Very akin to what you see with quote unquote boring businesses, where people are buying, laundromats or, I don't know, HVAC companies, things of that nature. And then when you start to go up market, that's where you really start bumping into, different business brokers, investment banks, which we do work with, and they'll list on our platform, whichever company they're representing. But that seems to be kind of the area that we've identified in the market that is kind of unloved and needed some attention. And so that's generally where we play. But we do play up and also down.
Cool. So I work at a tech company. I absolutely hate my job, can't stand my boss. I want to go buy something, be my own CEO. What's next, right? Like, I know about acquire. I think maybe I want to do something. How do you think about things as far as diligence goes? And then what have you seen as far as successes, maybe people who are repeat users in the platform, or, just firsthand have been successful? What would you identify as kind of some of the common traits of both the person and then what they're looking for when they come to acquire?
Good question. So the first thing in terms of what they're looking for is definitely profitability. So that's important because that's how you're essentially going to repay whatever investment you make towards acquiring a company. So as an example, typically we see SaaS businesses that are profitable, and that's, again, our main focus. So if you list a SaaS business that's profitable of over 100,000 or more, let's just say as an example, it's profitable yearly by $500,000, that business will get, like 10 LOIs on it. So a lot of interest around those businesses because number one, it's profitable. Two, the revenue is recurring, so it's predictable, and that allows you to forecast really easily how you're going to pay back your initial investment. So if you pay, $2 million, 2.5, $3 million for that, you can forecast out, okay, if nothing changes, it's going to take me 4 to 6 years to pay this back. And that's generally how financial buyers are going to be evaluating a business and putting a final valuation on the company. So that's one thing. And then in terms of, more specific items that first-time buyers are looking for, it can depend on just interest. Like for you, Sean, maybe it's something in finance, maybe it's something in sales or something like that. Like one recent acquisition that we did that is kind of a fun story. It was an individual who sold a subscription-based agency that consulted with other companies to help them with sales. And this individual sold his company on Acquire for about $3 million, and he sold to it was a husband and wife company, and he sold to another husband and wife, and the wife took it over from the other husband and wife. And she basically was working at a tech company and wanted to run her own company. But the main benefit of doing that is she gets to skip the 2-3 years of eating glass, trying to find product market fit, scraping by, and just finding your first customers. So you get to leapfrog those initial years and arguably increase your chances of success because you're dodging some of the earliest pitfalls with businesses. So that's one. What else can I think of off the top of my head? We see quite a bit. Different verticals, different company sizes. Another buyer that we see that I'll just bring up, and I think I've mentioned this to you in person, but on the lower end too, we see a lot of people acquiring smaller companies that are just really good at focusing on one type of go-to-market strategy. One story that I like to share is there was a company on Acquire that an individual bought for, let's call it like $50K or something like that, something outrageously cheap. It was like an AI PDF reader or something like that. He rebranded the company to PDF.ai, and now it's doing like over $500,000 a year or something like that. And when he bought it, it was doing like $10,000 a month. So there's some diamonds in the rough where it's just a great product built by, a technical founder that doesn't have maybe the energy or doesn't want to grow the business or doesn't have the go-to-market chops. And so a new owner can come in and just breathe life into that business and stand up a few customer acquisition channels pretty quickly. It's obviously a lot harder than I'm describing it, but those are two things off the top of my head.
Sure. You mentioned profitability earlier. That's obviously not a binary thing. Is there kind of a minimum amount of margin that you're looking for? Or is it just, I know that's dependent on the business, so it's kind of how long is a piece of string, but is there, if you're looking at it, everything as just like a filtering mechanism, because you get a lot of entries, there's, hundreds or thousands of different companies you can sift through using profitability as a filter. What's kind of a minimum threshold that you would look at?
In terms of margin, I would say probably at least 30%, but you want to get to like 40% ideally. I would say what's more important than margin though is probably operating history. Like for example, we see a lot of businesses that'll come in and they've been around for a year and a half or something like that, and their margins are great, they're growing super fast, but there's a lot of risk on those businesses because you don't know, is AI going to disrupt these things? Or is it just an AI company? We see a lot of that as well. So those can be riskier acquisitions. So I typically like to see 3 years of operating history. And this is also required if you're looking to get the business financed. So if you're looking to use an SBA loan or a different third-party lender, you're going to need about 3 years of operating history, tax filings, margins above 40% typically. So those things, I would say operating history and then margin above 40% is a good acquisition.
Take a slight detour here. You've mentioned SBA loans a couple of times. Why is that beneficial? Why should people look at those? And then is that used in combination with like seller side financing? Can you give us just a little bit of a lay of the land on those?
Yeah, so SBA loan is a government-backed loan where you can essentially buy a business for up to $5 million. It's the maximum cap on those loans. They can be a little bit challenging to get, but that's also something that we help with at Acquire, is just finding the right bank to work with to secure that loan. But the terms can be fairly favorable. The interest rate on those is about 10%. Typically, you have to put down around 20%. So as an example, you can buy, a $1 million business, you put down 200K, and then you have to repay that loan over typically a 10-year period. And the interest rate, again, is around 10%. And so what you can do, very similar to when you're buying real estate, as an example, you can essentially buy a business that's profitable enough to pay down the loan with just the profits that are coming from the business. So it can be an easy way to buy the business with leverage where you don't have to put down the $1 million up front. The only downside is it does come with a personal guarantee. So if the business goes sideways, you're going to be on the hook for that whole $1 million. So that's why due diligence is so critical and so important. And that's kind of what we're seeing a lot of buyers acquire businesses with, is some form of third-party financing, especially in that range that I told you about. We do see a lot of all cash offers as well. It just depends on the business and what types of structures the owners open towards. And like you mentioned, we do see a lot of seller financing. And for those that don't know what that is, it's essentially, Sean, I'm going to buy your business for $1 million, but I'm not going to give you $1 million up front. What I'm going to do is, a typical structure I like to see is 70% cash on close. And if I'm getting too in the weeds, Sean, just pull me out. Let me know.
This is good. Weeds are great.
Yeah. Okay. So I'm buying your business, 70% all cash, and then 30% is going to be seller finance. So what that means is I'm going to pay $700,000 at the day of closing, and then we're going to have an agreement between me and you, Sean, where I'm either going to make monthly payments or quarterly payments, or sometimes maybe even like a balloon payment, which means, after like a year or two or something like that, all at once. And what that does is that de-risks the acquisition for me. And what it does for you is it closes the deal, because what every buyer is trying to do is de-risk acquisition, because some of these acquisitions can be very risky. And they can be risky for a number of reasons, but one main one is you don't know exactly what you're buying. So you buy the business, day one, you find out the founder is doing all the sales or something like that. Day one, you step into the business, the code is a complete mess, and you have a bunch of questions. How do I fix this? It's a 5-minute call with the founder, or it's 2 weeks with a dev shop, or you as an engineer, or something like that. So it just mitigates risk, and I think it also aligns the buyer and seller really well. But also as a buyer, it again allows me to not put down the whole initial $1 million, and that can broaden the buyer pool for sellers, so it's also beneficial. But that's also a really common deal structure. We also see things like conditional holdbacks, earnouts. As your valuation gets higher, typically you see more terms and less all cash on close, like 100% all cash on close. Yeah, all those terms we absolutely see, and we actually recommend them too to both sellers and buyers, because it broadens the pool of potential buyers for sellers, so they can get the deal across the finish line. And then for buyers, again, it de-risks acquisition, so they can buy a larger business without having to put the full purchase price down at the time of close.
Okay, great. And that might have been jumping ahead a little bit, but I think just to come back, due diligence, obviously, most important part, right? Can you give us a framework for how you go about doing that properly?
Yeah, it depends on what your expertise is, but it depends on the size of the acquisition. Like, for example, if you're looking to buy small business for, $100,000 or something like that. And this is what I always recommend too, if it's your first acquisition, buy something small and then go through the hoops and take everything seriously and send a formal letter of intent, sign a formal asset purchase agreement, do proper due diligence, and just go through all of it, and then make your mistakes on a small business before you go up into the millions of dollars. But in terms of, what I like to see is definitely what I call a due diligence schedule. So you have a plan in place before you enter into a formal letter of intent with a potential entrepreneur to buy their business. So what that means is you have a plan. And typically that plan will look like week 1, we're going to go over all the financials. Week 2, I'm going to dive into the product and how well is all this structured. Week 3, I'm going to go over how do general operations of the business work. Week 4, I'm going to go over, the legal aspect. And it depends on the business and what's needed to run it. But essentially what you're doing is you're focusing heavily on, verifying everything that the owner of the business has said. So growth rate, how much is it making per year? Maybe they gave you a P&L with expenses broken out and stated profitability and margin at a certain number. You're going to, verify all of that. Basically making sure that everything is true. And you're also going to learn a lot about the business in terms of how does it operate? What needs to be maintained? What are some areas to potentially grow the business? What does a product roadmap look like? There's a lot of, smaller items, but the big ones are definitely, making sure that the product is what was advertised and isn't basically going to blow up behind the scenes. Then also the financials are accurate and were correctly represented, which is key, especially if you're using some sort of, loan or financing for the business, because those numbers do need to be accurate. Otherwise you won't be able to finance it. But my best recommendation there, and this one might be surprising, but I recommend hiring like a third-party firm to do like a financial audit, even if you're technical or something like that. Because one mistake I see a lot of people do is they enter due diligence and then they realize there's just so much stuff to do. Even if you're a financial whiz and you can go through Excel sheets and stuff like that, no problem. I definitely recommend, getting a quality of earnings report, really diving into the business with a firm that, and we have a number of, third-party partners that we work with, but this is like the best insurance that you can buy, especially if this is an acquisition you're going to be making to, again, jump out of that tech job you hate and step into, we call it entrepreneurship through acquisition. And so if that's what you're looking to do, just, work with a third-party firm, view it as insurance and have it all done correctly, and you'll have a lot of peace of mind. But rounding it out, due diligence is basically, again, verifying everything and making sure that whatever you are acquiring is in fact how it was advertised to you.
So if you're hiring a third-party firm, what's a reasonable expectation that you should add to the purchase price of whatever it is that you're buying? Do you think about that relative to the size of the business, or are those fairly fixed, more or less? And what are those amounts typically?
Yeah, good question. It depends on who you're working. Like you can just hire someone, but there are specific firms that we work with where they specialize in financial due diligence or technical due diligence, or operational due diligence. And typically it's, $5,000 to $10,000. The most important, I'd say, is the financial one. Obviously technical is important as well, but if you're going to do just one, I would highly recommend just doing a financial audit. And you can get those done for, less than $5,000, and they typically take less than a month.
Yeah. Okay. And what about the whole process? I mean, from interest to actual closing, what do you peg that at typically? 6 to 9 months? Is that reasonable? Is it shorter?
That's long. It depends on who you are. So I've seen, you mentioned some individuals at the beginning, and we work with both those firms, Tiny and Enduring. So if you're a seasoned, PE person, typically the selling point is 30 days due diligence. Like when I sold Bizness Apps, due diligence was 30 days, and that's pretty aggressive, but it can be done. But that's like you're shuffling papers every single day until like 9 p.m. So I'd say a reasonable time frame is like 2 to 3 months. When you start getting over that, one important thing to note is, and I've seen this too many times to count, and this is where deals can kind of blow up too, is there's something called just deal fatigue. So when you have due diligence go into like month 4, month 5, month 6, the founder is going to get fatigued. He's sick of you, not all the time, but there's just something that creeps in where, you're going to wonder, is this deal ever going to close? Blah, blah, blah. And then as a buyer, you're probably going to get frustrated with going through that as well. So before you enter into any sort of LOI or something like that, and we actually do screen for this at Acquire, is we'll get on the phone with buyers and we'll ask, number one, can you verify proof of funds? How are you going to finance this acquisition? Do you have cash, loan, whatever? And then do you have any experience with acquisitions, or do you have a plan for due diligence? And that's super important, even if it's your first acquisition, because Sean, if I'm using you as a big example, but if you're selling me a business, or let's say I'm buying your business, the last thing you want to do is work with me as a buyer if I don't have a plan. So we sign an LOI and you're like, yo, I'm going to sell my business. And then week one, I'm like, surprise, I have no idea what I'm doing. Let's hop on a call or something like that. So it's good to have it outlined where I say, Sean, we're going to be doing this for week one. I have it all outlined. And then I also go as far as saying, like, we can probably close within 6-8 weeks. We might run into a snag here. If I'm using, financing, just being upfront about that, like, hey, I'm going to need to verify this, and here's kind of how the deal might not go through. But yeah, 6 to 9 months is a year in acquisitions, if not more.
And in general, just to come back to a little bit of the due diligence, you mentioned kind of finances. If they're, don't have accurate financials, maybe that's just, ignorance. Maybe it's an early founder that's not something they're really focused on. They were just kind of building product. Maybe, I'm sure this happens sometimes, but hopefully not all the time. Is something a little bit more intentional. What are other red flags that you would see where you'd just flat out be like, nah, I'm going to walk it. This is just not the right fit and is an immediate deal breaker?
Yeah. So the financial part, surprisingly, it's really common. And it's of no fault to the founder. It's just not a lot of companies at, the 2, 3, 4, even 5, even 10 million mark, they don't hire a VP of finance. They got someone doing the books, and I don't know, it's typically a technical founder, or maybe a founder with a little bit of, sales chops. Again, you got to think about the construction of a company. So it's typically not until you get to, 7, 8, 9, 10 million revenue, where you're really building out a bench of, VP of sales, VP of marketing, VP of finance. So they just don't typically have the best financial housekeeping. We do have some tools at Acquire that can help. Like, you can connect straight into their whatever booking system they have, like QuickBooks, and we can pull out a P&L for you. Or if they're using Stripe or whatever billing system, we can pull out churn, monthly recurring revenue, average revenue per customer, all that fun stuff.
But you're not suggesting that's like a substitute for due diligence. You should still go hire someone to look at that, because they might have entries in QuickBooks that may not be accurate.
Yeah, definitely. Like, one thing about one common error that we see a lot is there's something called add backs, quote unquote, where we get to a final, instead of EBITDA, it's SDE, which is seller discretionary earnings, which is basically net profit plus whatever sort of expenses are incurred by the owner of the business that won't be there when they leave. As an example, their salary, maybe they're putting their car on the company. Maybe they put, $50,000 vacation on the company, or $25,000 for some conference they went to or something like that. Usually, again, one-time expenses, and also recurring expenses. Like the business I was describing earlier, the SaaS focused agency. I remember he had like his wife on. Like, it'd be awesome to do that, but you'll see a lot of these ad backs, and sometimes they aren't necessarily accurate. And what I mean by that is, like, they shouldn't be counted as profit, but the owner of the business thinks they are. And so just getting someone to kind of clarify all that can be helpful. But moving on to other red flags, what are some common ones? I would say valuation. That's usually a big one that just kind of shuts it down for everybody. If, there's definitely kind of the IKEA effect with startups, where founders, and I did this too, where basically, I don't know how to value my business. Everybody tells me just take revenue and multiply it by 10. And, the company's worth $100 billion, but that's typically not the case. So realistic asking price. One soft one that I always like to recommend and tell people to focus on is understanding the psychology of the business owner and do you get along with them? So I've never seen an acquisition go through where the two people are kind of at odds or can at least like have a small laugh together. That's kind of a page out of Warren Buffett's book. He has this quote: "You can't do a good deal with a bad person." Which, I'm not necessarily saying they're a bad person, but again, you want to be able to like jive with the person or trust the person. If they're giving you, if your gut's telling you something, it's probably for a reason. Other ones, if you talk to, I mean, just looking up like the reviews of the business can be helpful. So if you got a bunch of customers that are saying bad things about the company or the product, or churn is really high, you can learn a lot from that. Those are probably the big ones that stand out, but there can be a number of other ones, such as maybe you go to use the product and it just doesn't work, or maybe it says it uses this type of technology and it really doesn't. Like we've seen some companies over advertise how much they're using like AI or something like that, and then it's really not at all. So there's some littler ones, but the financials, the valuation, and then just how you get along with the founder are typically the biggest, as well as what customers are saying about the business.
That was going to be my next question. So you read my mind there a little bit, but where do you fit customer calls into this whole thing? And if you're in, I think also kind of a competitive landscape or a competitive situation for a particular, company that you might have interest in, are people sometimes, waiving the right to do customer calls and things like that? And is that something you see as absolutely mandatory? And where do you fit that into the process?
Yeah, I think customer calls, I mean, before you even submit an LOI, you can just do a simple Google search, like company reviews or something like that, and learn quite a bit. And then as you get into due diligence, I think that's where it's most appropriate to just ask you, like, hey, Sean, can I get 5 customer references? And then you send them to me. And then I'll talk to those 5 customers and get their take on everything. So that's typically where I think it's best, because it can be a little disruptive to a business if you are calling the customers without permission. But if you're selling your business, you should probably expect people to just call customers anyway. Just like when you apply for a job, like people are going to backdoor reference you, which means they're going to find references that you didn't give. But asking for the customer interviews is most common and what I recommend, and then also doing some sort of research on your own.
Yeah. You also mentioned kind of starting small, which I think makes a lot of sense. There's probably some balance that people have to consider for also having like skin in the game to some degree if it's so small that they don't want to pay attention to it necessarily. How do you think about appropriate sizing of that, and then just the time commitment? Like, I think there's probably some expectations out there of people doing this for the first time of, oh, hey, I'm just going to buy this company. It's just going to cash flow me, something every year, and I'm just going to sit on it. It's not going to be, that much maintenance. But is that realistic? Could that be a part-time thing for people who may still want to kind of maintain their position at an existing company, or should people just be all in on that new thing, whatever it is?
So if you're listening to this and you're thinking, okay, I want to look at acquisitions and like I want to go on the smaller end to start. Yeah, I mean, as a personal example, I acquired this little Shopify app. It was doing, I don't know, let's call it like 30,000 a year in net profit. And yeah, that's exactly what it did. I hired someone to handle customer support and kind of forgot about it. And then checked the business's bank account, and there was, I believe like 25,000 or something like that. I only kept it for like a year. There's a longer story behind that acquisition. I did it with like some friends and but yeah, like there are some businesses but you need to realize that, like every software company does have a shelf life. You're not going to pass these businesses down to your children or something like that. Like they're going to get disrupted. They're going to break. It's software. Something's going to happen. Maybe a library in your code goes out of date and you need to update it. So my experience there is probably on the more rare end, or not a realistic expectation, but it's possible. Like Shopify SaaS applications are a great starting point, because they're basically I call them SaaS companies with training wheels. And if you're not familiar with Shopify, you're probably maybe living under a rock, but it's an e-commerce company that helps people create their own e-commerce store, and they have a whole third-party store where you can have, like, the Shopify app that I bought allowed people to, what did it do? It was so simple. It had like a countdown timer to create like FOMO on e-commerce sales or something like that. So you can buy some like really simple ones that can actually work. But what I would recommend doing is write down like, what are your goals out of this? And if that's your goal, you're going to want to look for like a very, very simple point solution SaaS app that does just one thing super, super, super well and doesn't require a bunch of setup or customer support questions or anything like that. So it's probably going to have a low price point. It's probably going to require a bunch of users. And typically built-in distribution is great. So like, we've seen a lot of interest in, there's a QuickBooks app store. We recently sold an app in the QuickBooks app store that was doing a good amount of revenue and profit. And it would just find its customers organically. So long story short, what I'm trying to say is if you want to get like a small app that, spits out some sort of profit as a side project, I highly recommend looking at like Shopify apps, QuickBooks apps, Chrome plugins, like something with built-in distribution. So you don't have to constantly finding new customers or anything like that, unless it has like a flywheel with customer referrals. But it's possible. I just would have your expectations where even if it looks great on paper, something could happen. So I hope that answers your question. It is possible, but again, just like anything, it's easier said than done.
Yeah. I want to talk quickly about churn. So especially I think a lot of these things that we're talking about might have, hundreds of users, for example, especially being a little bit more software oriented. You're not going to be able to, customer call tons of those people or anything like that. A good thing to look at is churn, obviously. But what in terms of, monthly, quarterly, annual churn is, the point which would be alarming to you? I know there's some, kind of write-ups on these online, depending on who you talk to, those numbers look very different, but, just based on what you're seeing through Acquire, what do you think is a reasonable expectation of churn for like a SaaS company, for example? And let's kind of separate that by, something that's B2B versus like B2C.
Yeah, definitely. If it's B2C, the churn is going to be probably really high. And that's just the nature. If you always, or I'm biased here, but if you're going to acquire a SaaS company, always go after B2B, because everything's going to be a lot easier in terms of churn management. Price point is usually higher, customers more defined. B2C can be typically businesses that go up really fast, they grow really quickly, and then they can come down just as fast, depending on if it's riding a trend. Like, for example, we saw a lot of these types of businesses that actually you would probably love, Sean. We saw a bunch of like stock market apps that helped people discover like order flow for options and stuff like that. And they were basically targeting Robinhood retail traders. We saw like Stock Ticker One. This was all like during the pandemic when there was a big boom. That those apps went up and then went down because retail traders on Robinhood had a spike and then a decline. I'm not too versed in that market, but remember that, and that's just one example. So sometimes you can run a fad with B2C companies and make a lot of money building and selling the app, but on the other end with the buyer, it might not be the case. So with B2C, I would say just both in general. Anything over 5% or even 4% monthly churn can be pretty, like, that's on the high end. I'd recommend probably nothing over 3%. Because if you think about it, that means you have to replace 1/3 of the customer base every single year. So that means if you don't do anything in terms of new customer acquisition, the revenue of that business and the profitability of that business is going to be 1/3, 33% lower at the end of the year or more. And so that can be really troubling if your whole plan was to, because again, when you acquire these businesses, you want to see some sort of return on your investment. So if your plan was to use the current, profitability of the business to get that return over 3-4 years, that's not going to happen. But depending on the market, standard churn for, let's say, if a SaaS company is selling to SMBs is around 3% per month, because SMBs go out of business. They cancel stuff. They don't spend a lot on software. So that's probably normal for SMB. If it's B2B and it's above that, you probably want to dive into that, because the best SaaS companies will have negative churn, where essentially customers may be still canceling, but it's offset by existing customers growing in terms of their usage of the product and how much they're paying. And those are the companies that you can just essentially have them, they don't acquire any new customers, they'll continue to grow. And those are by far the most desirable businesses and the best businesses to build and obviously acquire. So yeah, I would just answer your question. I would say probably 3% is like the highest monthly. I would, and then anything above that, I'd probably avoid.
Yeah.
Oh, unless you can fix churn. Like you can definitely, there also is a strategy we haven't really touched on too much, but I'll just mention it quickly. But we also see a lot of buyers that kind of buy these businesses where they have these problems that the original founder couldn't solve. And that could be churn, that could be sales, that could be even when it gets above $1 million in revenue. So if you're really good at solving customer churn or increasing sales or whatever it may be, that's where you can get some, quote unquote distressed acquisitions at very favorable prices. And if that's your thing where you can fix them, we see people acquiring those businesses, putting them back on acquire, reselling them. So that's also an opportunity if that's your expertise.
Yeah. And no business that you're going to be buying, doesn't matter, on acquire, off acquire, large private equity companies, whatever it is, everything's going to have a problem. Some of those are probably constant and ever present in the industry. Like you mentioned with software, you get a library that gets deprecated or something like that, but then others are going to be, idiosyncratic or unique to that business. And then you need to, through the due diligence process, kind of suss out like, hey, am I uniquely suited to solve these 3 problems that this business is facing or whatever it is? Or can I partner with someone who's really good in one of the areas that I'm not? Is that kind of the right way to think about it? Is just this whole thing is identifying like what problems you're trying to solve for?
Absolutely. Yeah. I mean, if you think about it, the best businesses to buy are the ones that people don't want to sell.
Yeah.
So especially for a SaaS business, if you're going to be paying, 4 or 5, 6 times, profit, you're definitely not buying like a net negative churn business that, is going to print money while you're on a beach or something like that without any issues at all. It's going to come with issues. Like, it's going to have some, think of it like a house where it's, it's going to have a broken window, but it's going to be built. It's going to be much easier than starting a company from scratch typically. The upside will probably typically be capped. It's not going to be, the next $1 billion company. Having expectations like that is great. And that's okay. That's the best part about these acquisitions, in my opinion, is the people acquiring them are not looking to change the world. They're not looking to, buy a company for $1 million and get 100 million back or something like that. That's just unrealistic. But what is realistic is being able to acquire these businesses. And like you said, some will have some bumps and bruises, but, being able to work on that and generate, a good amount of, profit from the acquisition over a, extended period of time.
Yeah. I just want to quickly zoom out, go a little bit more macro in terms of what you're seeing as far as multiples and things like that. I mean, so much of just, the economy, macro environment drives everything. Interest rates, I'm sure a lot of people, if they're using financing, obviously that's a lot more expensive now. So if you have cash, maybe you can get a little bit, better pricing and better deal. What are some of the things that you're seeing, things that you would lean into and then maybe avoid? Obviously, I don't think I've been in a conversation recently where AI doesn't come up, but, how are all of those things impacting, what you would consider to be businesses worth buying?
Yeah. Again, kind of a cop-out answer, but you got to lean on your expertise. If you're good at, sales, buy a sales-related company. If you're technical, buy, a product, led growth or a PGL. But in terms of valuation, we're typically seeing businesses not really affected too much. Like we see a little bit of kind of like up and like down, but not compared to 2021 and 22 when things were, even 2020. That's when things were just absolutely bananas. So the past few years have been pretty stable. And what I mean by that is for these types of acquisitions, I'd expect to pay 3 to 7 times net profit. That's typically a good multiple. Obviously, there's going to be a difference between, say, an agency to a SaaS company. So the quality of the revenue, service-based versus recurring, is going to be different. Recurring revenue is going to have a premium on it. And then other things like we haven't seen any sort of trends where if you're purchasing with a loan compared to just cash, because at the end of the day, the founder, the owner of the business is still going to get paid cash, whether that's a loan or out of your pocket, Sean. But some things that we do see is if you're able to pay in all cash at closing, I can get you a discount compared to someone who's maybe buying the business. Like I'm the guy buying 70% cash and close, 30% seller financing. So there's also ways to be the best and final offer if you're focused more on the terms that are important to the founder. And sometimes it can be just asking. But other trends, AI, gosh, we've gotten pretty strict on AI companies. So one other thing to note about acquirers, we do curate every listing that comes into the marketplace. So we do due diligence on these. We do review them. We only accept about like 5% of the submissions that we see. And we've gotten a little bit more strict with AI because we don't know what's going to happen with them. Like as an example, we see a lot of 6-month-old like doing hundreds of thousands in revenue, and we kind of just say like, hey, come back in a year or something like that, because we don't know how to value them, and neither do buyers. That's been main feedback from buyers is literally like, hey, can you stop listing so many AI companies? And so we did, because it's very risky. And so we listen to our buyer network a lot. But in terms of the best buys are kind of our bread and butter, which is again profitable SaaS companies with a good amount of operating history, and that has remained pretty resilient through kind of the ups and downs in the economy.
Yeah. Well, I know we're kind of coming up on time here a little bit, so I think just to kind of walk through, recap, if I'm looking at the platform and different companies, a good kind of starting point is like minimum 3-year operating history. You're profitable, maybe with at least 30% net profit margins, maybe plus or minus a little bit. Be flexible with that depending on the business, but that maybe is a good starting point. And then moving into kind of manual reviews of like, hey, what's interesting to me? What do I think could kind of point a little bit more to my skill set? Then you can go through due diligence, and in that due diligence process, maybe you're calling some customers, trying to really tease out like what are the issues with the business that I personally need to solve for? What are kind of the growth prospects? Is all of this going to hold up? And then working with some of the folks that you can provide to say, look, third-party audits on financials, on product, like, hey, does all of this hold up as it should? And then kind of moving into the LOI stage. What would you add? What do you think I missed? I know that was quick, but anything you kind of add or amend to that like 10-second download?
I think that's good. I think also just, again, understanding, what value can you bring to a business? Because I think that'll really drive your decision-making process in terms of, what you go after. Again, if you're great at sales, my gosh, there's so many opportunities. If you're good at marketing, there's a ton of those. If you're technical, there could be an opportunity to, I'm sure there's a bunch of customers screaming for a certain type of feature, and that might be an opportunity to raise prices or charge for that feature. So understanding what you're good at and how you can apply it to whatever business you buy can be huge, because you could buy a business and double it fairly easy. There's usually some pretty obvious growth levers.
If you know something where I can double my money easily, just send me a note. I'm free anytime.
No, put a disclaimer on that. It's always easier said than done. Yeah. But if you're an expert at it, some people do make it look easy.
Yeah. Cool. Well, thanks for the time today, Andrew. This was awesome. For anyone who has not heard of Acquire, seen Acquire, even if you're not looking to buy or sell a business, go check it out. It's pretty awesome. Kind of like almost like a, not quite Yelp, but a nice like directory of just things that people are building. And I just like looking at seeing, you know what's out there. I window shop a lot. Not always a serious buyer, so probably one of the people you hate, but it's cool. Anyway, go check out Acquire. Thanks, Andrew, for doing this. It was awesome.
Yeah, thanks for having me, Sean.